Well, good morning, everyone, and thank you. I'm happy to be here on behalf of your conference in Sinai. It has taken 3 years, but not for lack of trying. It was just a matter of conflict of schedules, so I'm really thrilled to be here. I got into it by accident. The first idea I looked at as a young analyst back in the early 80s turned out to be a gigantic fraud. And I had no predisposition to be looking on the short side fundamentally for ideas until after that all unraveled. It was a company called Baldwin United, the old Baldwin Piano Company out of Cincinnati, Ohio, that morphed into a giant financial services company that was playing major accounting games. And after that company collapsed, it was the largest corporate bankruptcy in U.S. history up until that time in 1982. We got phone calls from our high net worth clients. I was working for a retail brokerage firm and hedge funds, saying, what else doesn't the kid like? And so I thought maybe, just maybe, I could carve out a niche in looking for institutional ideas that were overvalued, not undervalued. And then I did it for another 3 years in New York at Deutsche Bank until I was on the front page in the summer of '85 of the Wall Street Journal on how this evil cabal of short sellers were ruining the prospects of these 10 companies mentioned by name in the article. And when you opened up the Wall Street Journal, there was one of those line drawings that the journal used to do. And it was a drawing of a child throwing a pebble into a pond. And the outer ring said the stock market. And then the next ring in said institutional investors. And the next ring in said hedge funds. The next ring in said traders. And then the final ring said short sellers. And I was the kid throwing the pebble in. And of the 10 companies mentioned, I should say that my bosses in Germany were not too thrilled with the article in Frankfurt. So I was told before the end of the day that my contract would not be renewed at the end of the year. The upshot was 9 of the 10 companies mentioned either went bankrupt or were indicted for fraud subsequently. So I was out of work, and I had a client that wanted me to run money for them on a diversified basis of our short ideas as a hedge to their long activities. And I could never do it because of the Chinese wall. So I called them up. I said, well, guess what? I'm out of work. And they said, great. We'll set you up in business. And that's how Kynikos got started in the fall of 1985.
It's a great story. So just to make sure that everyone in the room is fully on the same page, could you perhaps explain to us why short selling is, why is it different? Like, why is it not just a mirror image of buying a stock?
So I often, when I started out, I thought that was the case. I thought that the research process, if you're a fundamental short seller, should be the same as if you're any investor, value investor, growth investor. You should be analyzing the company, its prospects, its valuation. But there are a lot of asymmetries with the short side to the long side, not least of which is the need to borrow the shares. The tax treatment in many jurisdictions is different. Variety of other sort of hurdles are put in your way. But the biggest one that I've realized over time is really more rooted in behavioral finance. And by that I mean that pretty much everybody in this room has been the beneficiary of what we would call positive reinforcement cycles in your life. Yet study after study has shown that most rational people's ability to make decisions correctly breaks down in an environment of constant negative reinforcement. The ultimate example of which would be, say, for example, an interrogation where your ability to withhold information is compromised by the interrogation techniques. If you think about Bay Street or Wall Street, whatever, they are giant positive reinforcement machines. I mean, they exist to basically sell securities, raise capital, and correctly so. But when you are a short seller, I wake up every morning and I look at my Bloomberg or my iPad, and I can be sure that of the 60 stocks we're short globally, probably 10 to 15 have some sort of news. Someone recommending the stock, someone upping an earnings estimate, CEO on CNBC, takeover rumor. And 99% of the time, it's just noise. But it's always there. It's sort of the Muzak of the investment business, as I call it. It's the elevator music, always on in the background. And if you are a short seller, that is, I said, just constant negative reinforcement. You're constantly being told you're wrong. And for most people, that becomes difficult over time. It becomes a life's too short kind of situation. And so I've sort of changed my view on this. I think most good short sellers at the end of the day are born, not made. I think that you have to have that constitution to just sort of drown that out and understand when the informational content is real and when you have to pay attention to that noise, but also when you can drown it out and just go with the courage of your convictions and your own work and your conclusions based on that work. So I think that there is a fundamental difference between the two sides of the market.
So notwithstanding that you said that short sellers are likely born than made, and it does seem like you're wired different than most. I'm wondering, given how many successful calls you've had and how difficult short selling is there something that perhaps, again, on the nurture side of the equation, that anything different about your upbringing that maybe drove you to this point?
It was dropped on my head at birth, maybe? I don't know. I don't know. I had a pretty conventional Midwestern upbringing, and I don't know that there was anything really different. I mean, again, I think we're all sort of different people. I know my oldest son, once sort of described me as saying, "Well, Dad's a glass half empty kind of guy," and I guess that probably describes it as well as anything qualitatively. But I think that one of the things that attracted me to the short side, as I got into doing investment ideas on the short side, was it was really kind of going up against people that I really thought were doing bad things to capitalists and capital, and it's part of short selling that gets short shrift, if you will. Is short sellers are the real-time financial detectives, and they're incentivized to do so, to be clear. But I've always said that the regulators and law enforcement are, in the financial market sense, are financial archaeologists. They'll always tell you 5 or 10 years later what happened with some degree of clarity, but that doesn't help the people in the room. It doesn't help investors. And there's an awful lot of bad stuff going on in the financial markets. Has been for 400 years. I teach a course about it, as you referenced. And that's not going to change. And having a active, skeptical short-selling community in the marketplace is like having a free press. I mean, I think it's kind of essential to the way markets operate.
So let me dig into that a little bit, because again, as we mentioned, you've identified some of the most notable frauds in corporate America. I mean, Enron, WorldCom, Sunbeam, et cetera, first to the scene. So is there anything, again, that in particular that contributed to your ability to do so, other than your natural predisposition? Is there anything that you think could be taught in spotting frauds?
Well, again, I think you have to understand, first of all, that the corporate world will always try to put the best foot forward, and most of the time justifiably so. But I think that it really behooves investors to be skeptical when something is too good to be true, and to understand that business is not that easy. I always go back to something that I saw back in 1998 that really kind of clarified what you're all up against. And that is, one day in the summer of 98, I was in my office. It was a very slow day, and I was thumbing through an old Business Week magazine, and there was one of those tear-out inserts. Now, I know nobody reads magazines anymore, but trust me, back then, they had the things called magazines, and you read them. And so it was one of those tear-out kind of little booklets, and it was a conference that Standard & Poor's had held. And if you remember, at the time, McGraw-Hill owned Business Week, They also own Standard & Poor's. And it was a conference that Standard & Poor's had for the Standard & Poor's 500 CFOs. And it was a summary of the conference. And in the back of the booklet, it had a series of questions that it had asked the CFOs at the conference anonymously. And the one that caught my eye was a question that said something to the effect of, have you ever been asked to materially falsify financial results at your corporation by your immediate superior? So I was like, that's interesting, because if it's the CFO, the immediate superior's got to be either the CEO or the COO. And the results were staggering. What really blew me away was that, as I recall, 55% said they had been asked to do so but did not. 12% said they'd been asked to do so and did. And then 33% said they hadn't. So if you think about that for a second, that's 2/3 of the CFOs of the Fortune 500 companies at that time had been asked to materially falsify financial results by someone in the senior C-suite. Lest you think that was an anomaly, almost the same exact question was asked 6 months later to the readers of CFO magazine, and similar results were obtained. Over half the respondents said that they'd been pressured to falsify numbers or materially inflate them. And this is what you're all up against as investors. There is a lot of agency risk out there. And there's a fine line between companies putting their best foot forward and crossing the line into embellishment or outright fraud. And it happens more than you think. And so this is really how we built our business, around finding these types of situations and using them as an offset to most people's long portfolios.
So, I mean, we talked a little bit about some of your successes, just so that the audience doesn't think you're a fortune teller. Yeah. Can you talk a little bit about some of your disasters?
Yeah.
And perhaps what were some of the most instructive or educational mistakes that you made?
So I had a shudder about a week ago when I saw going across the tape that AT&T was interested in Time Warner, because our biggest disaster ever was the shorting of America Online in the late 90s. We were short America Online at about $10 in late 1996. And these are all split adjusted numbers. And I think I covered my last share around 80. So that'll get your attention for a lot of reasons. Not least of which is the old, you can only make 100%. You can only make 100% on the short side, but you can have unlimited losses on the short side. And we were short America Online for accounting reasons that ended up being true, but ended up being irrelevant. Because a year and a half later, Time Warner and America Online merged, and Time Warner felt the brunt of those accounting problems. Unfortunately, not my investors. And we underestimated the ability of the crowd, if you will, at that time to get so infatuated with a concept that it would completely ignore for at least 3 years what were very clear warning signs on the accounting at America Online. And so you can be very, very right about your numbers and still not get the stock right on the short side. A more recent example that has been a lot less painful, but it just drives home the point, is our call on Caterpillar Tractor, which we've been short for the last 4 years. And while not a fraud, what was very clear to us was that Caterpillar had expanded too fast into the top of the commodity cycle. It bought Bucyrus Erie right at the top of the commodity super cycle in 11. And that estimates were just way, way too high for Caterpillar, meaningfully too high. The stock had tripled off its bottom. And so we started shorting the stock around $87, $88 back in 2012. Well, fast forward to 2016. In 2012, they're supposed to earn $15 this year, and I think $18 in 2017. That was the estimate in 2012 for now. Actually, they're going to earn $3.30 or so this year, and I think probably less than $3 next year. So we couldn't have gotten the business more right as analysts, as security analysts, in understanding what would happen to Caterpillar's business. And the stock is 87. I mean, it hasn't moved. Now, over the course of the last 4 or 5 years, that's maybe not so bad from a relative point of view, but it hurts when you get something that right, and investors, again, just seem to not care because Caterpillar's paying out a big dividend, and central banks are going to ease forever, and so on and so forth. So you can be fundamentally right on the short side, and still frustrated because of the overall generally upward move in securities prices over time. Now, we've alleviated that in our business model by hedging most of our short portfolios for our clients, which is a much better business model. But again, a little bit frustrating when you get you couldn't be more right on your analysis, and yet the market just doesn't seem to care. So
just piggybacking off of that, given what you've said about the unlimited potential liability of a short seller, so how do you develop the conviction in the downside protection of your ideas? How do you handicap the risk in that scenario?
Right. Well, a few things. So as I said, you can only make 100% on a short idea. By the way, that's not correct either for lots of mechanical reasons. I mean, you can compound a short position with just your initial capital if you happen to be right, without having to put up another dollar. But having said all that, I've seen a lot more stocks go to zero than infinity, right? So there is that reality of the situation. And number two, people think too discreetly, Mo, about their short ideas for lots of, again, these behavioral finance reasons. And for us, it's a portfolio, just as it is for the long side. I mean, we have domestically 40 names, globally 60 names. Every idea is 1 to 2% on average, 3%, 4% if we really love something. And so no one idea is going to take us out of the ball game because of portfolio management and risk management. Even if we love something, to not bring up a bad name in Canada, but Valiant Pharmaceuticals, which was one of our big successes in the past 18 months, doubled on us first from 130 to 260. And we actually were covering stock above 200, even though we loved the idea, to keep it within our risk parameters, and adding to it back below 200 and even below 100 as the news got worse. So it's like anything else. I mean, you have to dynamically risk adjust your portfolio every single day, not just sit there and let things go up. In the America Online example, America Online went up 8-fold on us. It probably cost us over 2 years about 5% in total performance. So that's because it was never much more than 0.75% of 1% or 1% position. We had a number of internet names on in the late 90s that we thought were accounting frauds. And so we just kept trimming it back, even though we liked it. It kept going against us until even we got sick of it. But it was never a position, despite the fact that it was up so much, that would ever imperil the portfolio over that period.
So just maybe kind of taking a step back, besides for the individual names or the risk management, is there an overarching investment philosophy that I guess you currently or have historically employed in all of your investment decisions?
Well, I mean, I think you do have to be flexible like anything. I mean, the opportunity set in the 80s was different from the opportunity set in the 90s, just different from the opportunity set now. The investment landscape's different. You were willing to carry high short balances in the 80s because you had a high rebate. Short selling throws off income. A lot of people don't realize that. You actually earn income on your short sale proceeds. Now, today, that number is often zero or negative because positions may cost you a negative rebate to borrow. But back in the 80s, before we saw the stock market move one way or the other, we were often up annually 12% because we would buy treasury bills as collateral, which would earn 6%, post that against our short sales for collateral, and then earn another 5 or 6% on the short sale proceeds. So there was a different environment then relative to today in terms of your cushion on risk, the opportunities, and where investors are infatuated. I mean, it was very difficult to be short things globally in the 80s and 90s. Disclosure was bad, borrowability was bad. Now it's almost every bit as easy as it is in Canada or the US. So it just depends. We don't try to pigeonhole ourselves. Having said all that, I mean, there are some consistencies down through time, some themes that we've seen in the portfolio. Not that we look for themes, but where we've seen our best ideas reside. One would be booms that go bust. And by that, we have kind of a tight definition. We call booms that go bust any credit-driven asset inflation where the cash flow of the asset being purchased with debt does not service the debt. So it's kind of a long-winded way of saying that the dot-com aspect of the late 90s didn't interest us as much as the telecom build-out part of the late 90s, where people, the Nortels and the Lucents, were building out the networks and spending a lot of money. Real estate bubbles tend to interest us because toward their end, people borrow money to buy houses or commercial properties that don't service the debt incurred to purchase them. And then again, you have a whole country in East Asia right now that is the epitome of this idea of just borrowing more and more money to finance its economic model. And we can talk about that maybe a little bit later. So that's one area. Another area would be technological obsolescence, where we've seen time and time again, particularly in the last 20 years with the advent of the internet, on how businesses that seemingly had unassailable moats found their business models completely compromised by changes in technology. And there, the general concept is that companies are not depreciating their capital bases fast enough to offset the technological risks to their business and find themselves in deep trouble after 5 or 6 or 7 years. So think of companies like Kodak or Blockbuster Video or a myriad of companies, the record industry, the record store industry, that have just been decimated by digitization. A third area would be companies that grow by acquisition. It is one of the last great legal areas of fraud, where companies are very aggressive in the way they allocate their purchase prices and play all kinds of games quite legally in melding other companies into themselves. And we find this over and over and over again, so-called roll-ups. Number 4 would be consumer fads, where we've just seen people get completely enamored with one product type companies and forecast sort of hockey stick-like growth, where yet the products themselves sow the seeds of their own demise as they increasingly saturate a consumer market. So think of things like Cabbage Patch Dolls, George Foreman grills, Nordic Tracks. I could go on and on and on.
I like George Foreman's.
and then finally, anytime we can sell $1 for $2 in some sort of classic arbitrage, where we see one security trading here and the ability to short an affiliated security or a spinoff or something like that because of some crazy market situation, we'll try to take advantage. The classic example there were the closed-end country funds. When the Berlin Wall went down in '89, for some reason, Japanese investors got enamored with the idea that Europe would have this new renaissance. So they ended up bidding up the values of the New York Stock Exchange closed-end country funds of, say, the Spain fund, the Italy fund, the Germany fund, which held large publicly traded liquid securities, to 300% of NAV. So, it was an amazing short sale until it went to 400% of NAV. So again, you kind of, and then some of them even went to 500% of NAV. Now, luckily, the squeeze was short because Wall Street and Bay Street, being what they are, decided to come out with the new Spain fund and the new Germany fund and the new Italy fund to fulfill the demand of insatiable Japanese investors to buy stocks at 4 times what they were trading on the exchange. And the arbitrage collapsed. But anytime we can do that, of course, we'll do that. So those are just some areas that down through the years we found a lot of our good ideas sort of fit in.
So I guess that leads us to, you talked about cyclicality, and listen, as one of the most highly regarded short sellers on the planet, where do you see us being today? In other words, where do you see today's greatest risks and opportunities, and particularly in short selling, but really generally?
Well, there's a few areas, Mo, that we're kind of excited about. I mentioned, East Asia, and we started looking at China in late 2009, because we were looking at the global mining industry, and I was trying to figure out why it was the global miners had record profits through the teeth of the global financial crisis. Now, I knew intuitively it had something to do with China, but I didn't really know how much. And it sort of crystallized for us in the fall of '09. I was sitting with my analytical team, and our real estate analyst was putting some numbers up on the whiteboard in our conference room. And he said, currently China had 5.6 billion square meters of high-rises under development, roughly half residential and half commercial and mixed use. And I thought for a second, and I said, Alex, I think you're getting the Western problem of square meters and square feet mixed up. It can't be 5.6 billion square meters because that's almost 60 billion square feet. And he sort of looked at me, as only a junior analyst can, sort of with terror in his eyes. He said, I know, I checked it 3 times. It's 5.6 billion square meters. And I thought for a second, well, if half of that is office, that's 30 billion square feet. And that's a 5-foot by 5-foot office cubicle for every man, woman, and child in China. And that's when it kind of hit me as to what was happening in this investment-driven model that China has employed. It is unprecedented. This swamps Japan. It swamps the residential excesses of North America. I mean, this is truly uncharted territory. I point out to people that when we started looking at China, the tropical island of Hainan, which is sort of the Hawaii of China in the South China Sea, it's a tourist destination. It had 1 international airport in 2010. And subsequent to that, it broke ground and has opened a second international airport that's only 30% occupied or utilized. And now it has broken ground on its 3rd international airport. So the first one was essential, the second one was a luxury, the third one is going to be folly. And this is the problem with China. And so I think that as a broad theme, you can look at that and say, okay, what are the various different companies that have benefited from this and will have to pay the price on the backside of it? I think that's one area that you should either look at on the short side or be careful with on the long side. Another one has to do, obviously, with the interest rate structure around the world. And we have no idea where rates are going. But where stocks have gotten bond-like status because of their yields, and yet the companies aren't earning enough to pay the dividends, we think there's a lot of risk in those situations because they tend to be mundane businesses. They're at all-time high valuations. And if everybody at any point just says, well, wait a minute, this is not a 3% yielding stock, a bond. This is a company trading at 50 times questionable earnings. And now I can get a better deal in the bond market. Those stocks have a long, long way to fall.
I just, a couple of days ago, I was seeing on various media channels where you were talking about Tesla.
Yeah.
So I actually thought you had some interesting views there. Do you mind briefly sharing where you stand with that today?
Yeah, there was a conference call last night. I would urge you to go read the transcript or listen to the conference call, because Musk was asked about Elon Musk was asked about the rationale behind the Solar City Tesla deal. And if you can understand any of his answers, please drop me a line because it was complete gibberish. It's amazing. I mean, I know that the guy is seen as a high-tech god, but for the life of me, I just couldn't understand what he was saying. It sort of read like a Donald Trump transcript. If you can understand what he's saying, let me know too. And so, it's funny. I did a conference a couple weeks ago out in San Francisco for Vanity Fair, and Bethany McLean asked me about Musk, and I just said, look, the numbers don't make any sense. The strategy behind the merger doesn't make any sense whatsoever. It's corporate governance of the worst sort. He's bailing himself out and his family out. Solar City is not a high-tech company. It's a roofing company with a consumer finance subsidiary. That's all it is. And that he needs to focus on the car company. He's going to be trying to make a $35,000 car against Mercedes, Audi, VW. And that market he doesn't have to himself. And making cars is a tough business, and being distracted by this huge money loser is baffling to us. And that's not a controversial thing to say on Wall Street. I mean, there's a bull-bear debate, but I mean, people have looked at the numbers. This is not off the reservation, right? I was assaulted at dinner that night by people in Silicon Valley. Go, you don't get it. This man is changing the world. I said, you don't get it. He's doing something else too. And so it sort of depends on your point of view and your perspective on these things, right? I mean, I'm a financial guy, and I'm looking at this company burning capital, and it might work, but it's doubtful. And yet, I saw quite vehemently the other side of these sort of, people who were just absolutely convinced that they could pay any price for his stock because he was a visionary. So, takes two to tango.
So just stepping back from some of the specific ideas, just notwithstanding your bias for shorting, how do you think investors should be positioning their portfolios today? So
let me just speak to my business. The way people get it sometimes wrong because they hear these stories and they think that we're just basically speculators on the short side. And I like to sort of tell our investors or prospective investors and interested people that the fact of the matter is I'm really in the insurance business. At the end of the day, the only reason you want to be short a portfolio like we would construct for you is because it enables you to be more long. I mean, really, at the end of the day, I'm not an end-of-the-world guy. I'm not a perma bear. I think progress continues. I think securities prices over time appreciate in line with their risk. But I also think discreetly that an awful lot of companies fail. There's a lot of agency risk, as I indicated. And if you can construct a portfolio of stocks that will actually make you money on the short side or not lose money as the market goes up, which we've done, you can be more long. Your shorts, in effect, finance your longs at zero cost, or they even pay you a premium. So if I could tell you that you could insure any dollar amount of your portfolio for no cost or at a positive return, you would do that all day long. And yet that's what reasonably good fundamental short sellers have done over the past 30 years. And I think it's an amazing value construct for anybody that's interested in returns. So that I sort of joke that for all the fun and games of the Teslas and China and America Online's, what we talked about, at the end of the day, we're all about hedging our clients' risk and doing it in a smart way. And I think that's why it's important, and that's why it'll continue to be important.
So just taking even a broader look, you're obviously a student of history. I've read lots of your work, and you speak to lots of intelligent people. So could you maybe talk about the best piece of investment advice that you've ever received?
Yeah. The best piece of investment advice only had an ancillary thing to do with investing. It was more career advice for a young person, and I took advantage of it. but I passed it on to my students as well as even my young analysts. And it's actually when I got basically fired from Deutsche Bank, told that I was not going to get my contract renewed. And this group that put me in business was, and the fellow who ran it had himself been a successful entrepreneur, and he was now running the money of a wealthy family. And when I sort of expressed doubts about the ability to do this at 27 for them, he said, let me tell you something. He said, the best time you can take business and career risk is when you're young, not when you're old. And I said, what do you mean? This is sort of, to me, it always seemed like, well, you'd put your time in, get your homework, raise some personal capital, get yourself established, and then if you want to do something, go out and do it on your own. No. I said, that's when you won't do it. You won't do it in your 40s or your 50s or your 60s. You can't afford to for personal risk reasons. You can't afford to for reputational reasons. And if you fail, it's a lot harder to come back from at that age.
You're all too late.
So pass this on to your kids then. But when you're younger, you have the ability to do that. And if you fail, in our culture, not so much in other cultures, no one holds it against you when you're young. In fact, they may take it as an advantage that you took a risk. And you might not have all those family responsibilities or financial responsibilities, charitable responsibilities that we all end up getting for a variety of reasons. And it kind of hit me. And he was absolutely right. And the corollary to that was that we all have learned in this room, I think, that when life throws you a curveball, you get knocked down, you pick yourself up, dust yourself off, and you keep playing. But we also forget that life from time to time presents you with the brass ring. And you also have to identify when good fortune smiles upon you and take advantage of it. Because I think that's when you move ahead, both personally and developmentally, culturally, financially, is when you sort of reach a little bit for when life gives you that brass ring. Because that'll happen a number of times in your life as well. And you have to be smart enough and non-risk averse enough to understand when that happens and say, okay, you know what? I'm going to take advantage of this opportunity. So those are two sort of related pieces of career advice that I think apply to everybody as well as just investment people.
So just, I guess we have probably time for one more question. If there was one piece of advice that you could give to someone that perhaps hasn't had much exposure to shorts or managers that are short biased, what would that piece of advice be? Besides, of course, invest in my fund, naturally, but any other advice that you would offer?
Well, I started my short fund when the Dow was 1,300, so I don't know that this is you're asking me the right person for this piece of advice. Again, I would say that for most people, speaking specifically to what I do, shorting should not be for them. For a variety of behavioral finance and tax and other reasons, I think it's best left to the professional short sellers. I will give you one other little odd anomaly. There are very few free lunches in our business, as you know, Mo. But the one thing that everybody worries about on the short side is, of course, unlimited losses. And I always point out to people that if you invest with a professional, you can only lose what you put up as a limited partner. If you think about it. The unlimited liability is on the general partner. And so it tends to be one of those few times where actually the market is handing you a bit of a free lunch from a risk-reward point of view. It also just goes to show you that, again, for most people, they should focus on structuring their portfolios soundly. But for those that have large, sophisticated portfolios where they do want to be dynamic about their risk hedging, whatever, it's hard to beat a good short seller.
Jim, cannot thank you enough for taking time out of your insanely hectic travel schedule and insanely hectic business schedule. We greatly appreciate your participation.